Question 31. The table below summarizes information concerning a market capitalization weighted index. So we've got three different stocks here, their share price, dividends per share, and end of period price per share, and shares outstanding. The price return on the market cap weighted index is closest to. So for market cap weighted index, essentially what we need to do is we're not going to account for these dividends for price return. That would only be counted for total return. And since this is market cap weighted, we need to use share count and beginning of period price to find out the starting value of the index. And then we can use share count and end of period price to figure out the ending value. And then we'll just do a simple return calculation. So here's what that looks like. Our starting value is going to be that share count times the price. So we can see that here, 45570 times 120. And then ending value is going to be that same share count times the ending value. So 45570 times 140. And then we're going to add that to the amount for B and for C. So it's going to be 200 times 59650. We see that right here, and then 112740 times 180. You see that right here. So we get 37,691,600, and then for starting value, and then for ending value, we get 39,330,700. So we're just going to do that ending value over beginning value minus 1 gives us 0.0345, which is going to correspond with answer B here, 4.35%. Question 32. Which of the following most accurately describes the overconfidence bias? A, market participants tend to dislike losses more than they like comparable gains. This is not going to be overconfidence bias. This is going to be our loss aversion bias. B, market participants tend to trade with other investors while potentially ignoring their own private information or analysis. So trading with other investors and ignoring our own private analysis, this is going to be kind of the opposite of overconfidence bias. If we were overconfident, we'd be digging more into our own private information and analysis and thinking that's superior. Whereas in this instance, we're trading with other investors. So this is going to be herding bias, or kind of going with the herd, doing what other traders and investors are doing. And lastly, C, which should be our answer, market participants tend to overestimate their ability to determine intrinsic values accurately and may not process information appropriately as a result. That is going to be our correct answer. The key here is overestimate. We're basically overconfident in our abilities to forecast the future and think that our that ability gives us a better secret sauce, essentially, to kind of pick stocks or different investments. Answer C. Question 33. In an MPV profile, the point at which the profile crosses the x-axis is most accurately described as the... All right, I'm going to pull in an example of an MPV profile. This is from AnalystPrep's website. And we can have this in front of us as we go through these answers. So it most accurately described as the project's IRR, the point at which MPV is the highest, or C, point at which the discount rate equals 0, and the MPV is the sum of the undiscounted cash flows for the project. So looking at this, this point here is essentially telling us what is our net present value of the project, and then what is it relative to the discount rate. So essentially, as we have a higher discount rate, that's going to lower the net present value of the project because those cash flows are going to be discounted by a higher rate. So looking at C, point at which discount rate equals 0. So the point at which the discount rate equals 0 is not where the profile crosses the x-axis. That's actually happening out here at 20%. And the NPV is the sum of the undiscounted cash flows. So that's not going to be our correct answer. B, point at which the NPV is at its highest. So we can see NPV as at its highest when we're at discount rate of 0 because those cash flows are not being discounted. So we can rule that out as well. So we can go with A, the project's IRR, which is kind of the definition of IRR. Our IRR is the point or discount rate at which our NPV will be equal to 0, which we can see from this example. Answer A. Question 34. In which of the following types of preference shares are shareholders most likely entitled to receive the standard preference dividend plus a premium dividend if profits exceed a specified level? So we've got A, cumulative preference shares. We can rule that out. Cumulative preference shares are essentially a preference where if the company misses a dividend, that dividend is going to accumulate, hence the name. And at the next dividend payment, shareholders should be kind of made whole for that last dividend payment plus what they're going to receive now. But they're not participating in any kind of upside of profits exceeding some level. B, participating preference shares. So this is going to be our answer. And the key way to remember it is right there in the name, participating. Participating preference shares are participating in the profits of the business to some extent. So if the business does well, they get some more upside in the form of a premium dividend. And then C, non-cumulative preference shares. They're not going to participate in the profits. And the difference between cumulative and non-cumulative is that if a dividend is missed, they're not going to be made whole for that missed dividend. That's just going to be not paid, and they'll get paid at the next one. Answer B. Question 35. Exhibit 1 shows the dividends paid by 2 Asian companies for the past 5 years. So we've got Exhibit 1, dividends paid to investors for these 2 companies. Which company or companies would most likely be valued using the Gordon Growth dividend discount model? So Yukeman, Chentao, or both of them. So given the data that we have, which is dividends in these 2 different companies, if we want to use the Gordon Growth dividend discount model, one of the key assumptions is that dividend growth is consistent over time. So the best way to go about this problem is we're going to calculate the growth rate from 24 to 25, 25 to 26, 26 to 27, 27 to 28 for both of these companies, and then see if that growth is consistent for them. And if it is consistent, then the Gordon Growth model is a good option. If not, then that will not be a good option. So here's what that math looks like. So for to get that growth rate, just looking at 2018, we do 5.39 divided by 4.49, gives us 1.2 or a 20% growth rate. And then when we do that down the line, we see we get 1.205, 1.1987, and then 1.2 for 2015. So it looks like Yukeman would be a good dividend growth model candidate, since this growth rate is essentially 1.2 at each level if we round. Then for Chentao, though, we do have more variability. So we've got 1.2, which is 20%. Then we have 1.129, which is 13%. Then we have 35% growth. Then we have 15% growth. So these are kind of a little more all over the board. So Chentao is not going to be a good candidate for this. So we're going to go with A. Only the Yukeman company would be good for the Gordon Growth model. Question 36. A market index only contains these 3 securities. We've got securities A, B, and C, price per share, and market cap. Which approach will most likely give security A the highest weighting? Price weighted, equal weighted, or market cap weighted? So we're looking at security A. For price weighted, we can rule that out right off the bat, since security A has the lowest price of B and C. It's most likely going to have the lowest weight of these, especially relative to equal weight, since equal weight is going to be 1/3, 1/3, 1/3. So it's certainly going to be lower than equal weight. So we can rule off price weighted right off the bat. So from here, then, we need to compare equal weight and market cap weight. And so let's pull in how we would calculate that. As we said, equal weight is just going to be 1/3. So we need to basically decide or compare whether the market cap weighting is going to be greater than that or not. So under market cap weighting, we're going to be using the market cap column to calculate this. So we'll take A's market cap, which is 2,000. We'll put that in the numerator. And then we're going to add up the total of all 3 stocks' market caps, and then put that in the denominator. So when we do that, we get 2,000 plus 234 plus 1,234, which gives us, when we divide 2,000 by that, we get 57.67%. So this is going to be greater than 33%, which we have determined is certainly greater than price weighted. So we're going to go with C, market cap weighted. Question 37. An investor buys 300 shares of XYZ at the market price of $200 on full margin. The initial margin requirement is 30%, and the maintenance margin requirement is 20%. So we're buying on full margin. That doesn't mean we bought on full debt. It means that we satisfied this 30% margin requirement, and we bought this $200 worth of shares. If the shares of the stock are later sold for $250 per share, what is the margin transaction return? So the price went up by $50, and so this is going to be really good for us because we were leveraged and the price went up. So here's how we're going to calculate this. Essentially what we need to know is our ending equity, and then we're going to divide that by our beginning equity, and then subtract by 1, and that gives us our return. So for initial equity, we're going to do 200, which is the price that we bought at. And then we did 30% margin. So we put up 30% of the $200 share price as our equity. So we have $60. And then ending equity, essentially all we have to do here is add the 250 take 250 minus 200, since that's the equity that we gained. All that upside is ours, since we don't have any information on the borrowing costs or anything like that. So all $50 of that is upside for us. So we received $50 plus the 60 that we had beginning equity. So our ending equity is $110. So we just do our return calculation from here. 110 divided by 60 minus 1 gives us 0.83333, which is going to be answer B, an 83% return. Question 38. Seniority ranking indicates the priority of payments in case of a winding up. Among the following, which one is the lowest ranked corporate debt? So we've got subordinated, second lien loan, or senior unsecured. So this is going to be our kind of general order. I think the easiest way to kind of remember it. So number one, we're going to have secured debt, meaning that we have some collateral behind this debt. And then right below that is going to be unsecured debt. And then thirdly is going to be subordinated debt. So looking at these three types, so we've got subordinated. So right off the bat, it looks like that's going to be our lowest, since I have that as third on the list down here. And then B, second lien loan. So lien is going to imply that this is secured by some asset. If it's a lien, then it has a lien against some asset. And so this is probably pretty high in the capital stack. The only thing it would be junior to is the first lien loan. So we can rule out B. And then C, senior unsecured. This is going to be below the second lien loan, but it will be above subordinated. So we can rule out C and go with answer A. Confidently choose A, subordinated. Question 39. Richard Grove invests in a 2-year 4% semi-annual coupon-paying bond with a par value of 1,000. The sequence of spot rates is as follows. So we've got time to maturity, 0.5, 1 year, 1.5, 2 years. So we would stop there at our 2-year bond. The price of the bond is closest to. Okay, so to determine the price of this bond, essentially what we're going to do is we're going to take our coupon, so 4% semi-annual on a $1,000 bond. That's going to be $40 paid annually, but since it's semi-annual, we divide that by 2, so it'll be 20. And then we're going to divide that coupon, so we'll have a coupon here, 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 and here that we need to discount by these respective spot rates. So here's what that is going to look like. We discount by the respective spot rates, and we divide the spot by 2 for semi-annual payments. So that first spot rate, and we're also going to divide the spot rate by 2 since it's semi-annual. So we'll divide the coupon, and we divide the spot rate. So that first coupon is going to be 20 divided by 1.005 for this first spot rate divided by 2. And then we're going to add 20 20 divided by 1.08 divided by 2. And since this is our second period, we're going to be squaring that spot rate. And I know that might be confusing since it's year one, but since we're doing semi-annual, this needs to be compounded for 2 periods since it's compounded only for 1 year, but for 2 periods. And then same thing down the line here. So for period 3, we'll take 2.9 divided by 2, which is going to be 1.0145, and that's going to be raised to the 3 since it's 3 periods. And then for the last period, we're going to have our coupon plus we're going to receive par. So that's going to be 1,020. And then we're going to divide that by 4.2% divided by 2. And then that's going to be to the 4th period. Again, since we're doing half-year periods, for 2 years, there's going to be 4 periods. And when we do that math out, we get 997.3359, which is going to be closest to answer A after we do our rounding. Question 40. A positive duration gap most likely exposes the investor to. So a positive duration gap is going to be our Macaulay duration minus investment horizon. So essentially what this is telling us is that we have a greater duration on our investment than is on our time horizon. So we might have a duration of 7, but our time horizon that we're going to need the money is in 5 years. So what kind of risk does this expose us to? Does it expose us to reinvestment risk and market price risk? So it does not expose us to reinvestment risk. Reinvestment risk would be if we had a negative duration gap. So essentially if our time horizon, if they were flipped. So if we had a time horizon of 10, but our duration of our bond was only 5, we would have a 5-year period where we would have to reinvest our coupon. And so in 5 years, we're not sure what that bond is what the yields are going to be in that date. So that's the risk there, that we're having to reinvest at lower rates to kind of meet our obligations. So we can rule out answer A, since we won't have reinvestment risk. B, market price risk from increasing interest rates. So this certainly could be our answer. When interest rates increase, this is going to decrease the price of our bond. And since we need the money in 5 years, but the bond doesn't mature, or maybe it matures longer, but the duration is 7 years. If we have rates that increase, our price is going to drop and it might not recover before we need that money in 5 years. So that's what the main risk is in a positive duration gap. And then C, reinvestment risk from decreasing interest rates. We can rule that out since decreasing interest rates is actually going to help us because that's going to move the price of our bond up. So we'll be able to sell at a profit in 5 years when we need the money. So again, positive duration gap, that's where we have market price risk. Negative duration gap, that's when we're going to have our reinvestment risk. Answer B.